Ladies and gentlemen, the very first thing that I would want to ensure that each one of us has is we must get access to our syllabus, course syllabus. We shall never ever work without a course syllabus. Every time we clear any topic, it will be very important that you as students, you need to get to that particular course outline given to us by CASTEB, and then you say this one is done. So you'll be marking the register yourselves. So for today, before I send it to the class group, I would want to simply project it here, but I'll also be able to attach it here for your own reference. Very interesting. All right. So ladies and gentlemen, this is what we have here. So I'm looking at advanced financial reporting. Yeah. So we are looking at advanced financial reporting. The most interesting paper. In CPA. So it is here. All right. So what are we able to see? I hope everybody can see my screen. It's called Advanced Financial Reporting and Analysis. This paper is intended to equip the candidate with knowledge, skills, and attitudes that will enable him or her to account for more complex transactions, prepare advanced financial statements and reports in the private and the public sectors, and demonstrate awareness of trends in accounting practice, So for instance, right now, I'm recording. Don't worry, I'm recording. I'll be able to give you this recording. That is the way I'm recording. All right. So, ladies and gentlemen, like right now, we have just received a notice of IAS 1 being replaced by IFRS 18. And we're going to have, for example, our income statement presentation being totally different. All right. So as a student doing this advanced financial reporting and analysis, you shall be required to appreciate the current developments in the body knowledge of financial reporting, that is international financial reporting standards. We have in this case here the financial reporting framework, right? As provided to us by the International Accounting Standards Board. All right. We have so many things happening in the moment. We have in this case here, for example, sustainability reporting. We have in this case here, for example, IFRS 17. Right now, insurance companies are being required to report on a new framework called International Financial Reporting Standard number 17. We have our learning outcomes. A candidate who passes this paper should be able to prepare financial statements for subsidiaries. So if you did group consolidation and you thought, hey, this is the last of it, it was just but the beginning. Here we are going to see group consolidation, both simple groups and complex groups here. So prepare financial statements for subsidiaries, associates, and jointly controlled entities in compliance with international financial reporting standards, IFRS, and international public sector accounting standards, IPSAS as applicable. Then analyze financial statements for public and private sector entities. Account for complex accounting transactions. Apply ethical standards in accountancy work and practice. We reckon the fact that however good you'll become in terms of number crunching, however good you'll become in terms of a creation of financial reports, if your ethical stances are wanting, if you are a thief, then there is no way the company you're working for as an accountant will be able to be run sustainably. For sustainability, we need accountants who are ethical. Then we go to the content. Topic number 1 is known as accounting for assets and liabilities. Accounting for assets and liabilities. So here 1.1, they want us to look at assets and liabilities as covered in financial accounting and financial reporting you did some accounting for assets and liabilities in FA and financial reporting. They will be relevant here. They'll be relevant here. And then straight away, we jump to 1.2, leases, including sale and leaseback and dealers in leased assets. So, ladies and gentlemen, using IFRS 16, we shall be required here to tackle leases very well. And the leases, we shall not be looking at the lessor accounting alone. We shall not be looking at the lessee accounting alone. We are required by our syllabus to look at, for example, what happened sometimes back here at Uchumi Supermarket, where the directors of Uchumi around their Aga Khan work. We had an head office there. So the directors went ahead and sold that building, got, in this case here, of course, a buyer for the building, and negotiated with that buyer to lease back the building, and they continued using it as a supermarket. So in this case here, the syllabus wants us to look at sale and lease back transactions. Ladies and gentlemen, according to IAS 12, deferred tax, income taxes, our examiner here, AFR examiner, is big on this concept of what here? Deferred taxation. This concept of deferred taxation. Okay, great. Deferred taxation. Now, ladies and gentlemen, from there, we go straight away to 1.4, employee benefits. These employees who are working for us, of course, we must give them short-term benefits, the salaries they are getting, but we must also guarantee them that once they retire at the age of 60, they'll be having some fallback positions in the name of what here, for example, pension schemes. So then if it is these pension schemes, how do we get to account for them? There are those pension schemes, retirement schemes, where we guarantee benefits. We tell these guys that, you know what, after you retire, you shall be getting like $1 million or 10. So we guarantee benefits. And then there are those kind of benefits here where we simply guarantee schemes where we simply guarantee the contributions. So shall be able to see, contribution scheme, guaranteed contribution schemes, and the guaranteed benefit scheme. How do they differ, and what are the key differences in terms of how we account for both? Then we have got share-based payments, IFRS 2, ladies and gentlemen. There are those workers, of course, who work for us, especially at our very initial stages, and then we are not able to pay them in cash. We don't have that money. So I've seen startups always telling these founders of these kind of companies that instead of us giving you cash, let's give you shares for this company. And if these guys buy onto the dream of the vision bearers and they accept shares, so in the long term, of course, they're going to benefit. So these employees, you have paid them in shares. So of course, that payment will be accounted for under what we call share-based payment, share-based payments. It's not only startups, even these big, well-established listed companies. At times, in this case here, to push their CEOs to work extra hard, they promise options where they tell these guys that by the time the shares of KCB will be going for this much, maybe 30 per share, assuming currently they're going for 10. So if they reach 30, then they're going to give you like this number of shares. So instead of giving them, in this case here, bonuses, we are giving them bonuses in form of what here? Shares. So that kind of payment, once you make a promise like this, it becomes automatically a share-based payment. It becomes a share-based what here? Payment. All right. Now from there, ladies and gentlemen, we have the concept of financial derivatives. Financial assets and financial liabilities, where they want us to look at impairment. Hedging from the Bible. We know that to hedge is to protect. So when we have, for example, a hedge, like the other day, not the other day, but quite a long time ago, Kenya Airways took some bold step and they were able to hedge against increases in fuel prices. So they bought a fuel derivative. So this fuel derivative, of course, which is a blanket that is covering the risks for us, it's a financial asset because at some point we shall be able to sell it. It's helping us in this case here against losses due to these price fluctuations. So it's an asset, it's bringing in wealth to us. So then how do we get to account for them? And the IFRS, for example, 9, and the IFRS 9. So I'm recording, don't worry, I'm recording. All right. So ladies and gentlemen, it will be very, very important for us to know how do we account for our derivatives? How do we account for these hedges? As you're going to see here, and your examiner is very, very, very broad and big on this. Your examiner will ask you about the various types of what here? Hedges. The various types of what here? Hedges, yes. So where you'll see, for example, we have what we call cash flow hedge. And the cash flow hedge, assuming RCM Online College is making like 20 million Kenya shillings every semester. You see, we get used to some standard here. Standard of even living. Standard of our employees getting good incomes. So we would want really a situation where that kind of cash flow is protected. So we could buy into some kind of hedging techniques just to protect ourselves against this kind of cash flows. All right. So that automatically becomes a cash flow hedge. Then we have what we call a fair value hedge. If we have got assets, like right now, given the floods going on, I can tell you there are very, very many farms that are going to make serious losses, including some of these listed companies that have been having very good buildings, say at Westlands. You can imagine any building, for example, along Westland that has, of course, experienced lots of water coming to the building there, automatically that house, if it had tenants, that kind of an asset has to be impaired. Because moving forward, you'll not be able to attract clients who will be able to give you rent of 150,000 a month. Moving forward, that kind of a house is going to experience high occupancy levels. Idle. A house is idle apartments. So in this case here, those kind of buildings have to be brought down. So once they are brought down, because now they're impaired, they're not able to produce the kind of cash flows they were producing, now the value is down, then we must get what we call fair valuation. You call in a valuer. So most companies would want like kind of insurance, which will be able to protect them whenever the fair values of the assets come down. So we have somebody who takes that risk. So we have what we call a fair value hedge. We have what we call a cash flow hedge. We are required by KNEC to dig deeper into those kind of hedges for you guys to be able really to tackle your exams. Remember, in AFR, theories are many. You need to have really a nice grounding for you to be able to answer AFR questions nicely. And so many guys have always come to me, especially when they go to other colleges and then they fail. They come back to me here. They ask me, Mwalimu, why did I fail? When I look at their notes, I realize that the teachers were very good, but basically they were being taught the numbers alone, number crunching. Like this is how we do IFRS 16. The teachers forgot what we call, in this case here, the theory. The theoretical framework is so big in AFR. AFR will be able to get about 30 marks, theoretical, which in this case here will be able to assist, yes, which will be able to assist, and we shall overcome. All right. Now, from there, ladies and gentlemen, we have what we call fair value measurement again as a different topic. Fair value measurement, this automatically is what we call IFRS 13. IFRS 13, which talks about how we should be able to measure values of our assets and liabilities. And you're going to see so many good things here. All right. You're going to see in this case here, for example, there are those assets. Whenever you want to value them, you only look for identical assets. And because those identical assets are selling there, we talk of input one kind of assets. Input level one. We have in this case here some assets when you want to value them. I mean, we don't have, yes, assets which are 100% identical, but we have similar assets. So you can look at how much were these similar assets here valued at? What kind of changes then do we make to our asset to be able to get its fair value? Then we have got, ladies and gentlemen, some assets that have got, just like some human beings. You know, ladies and gentlemen, some human beings will be quite, resembling others outside there. And we have in this case here some human beings that were uniquely created by by God himself, uniquely, fearfully, and wonderfully made. I mean, they don't resemble anybody. Just for example, like look at this church near City Hall, Nairobi. That church near City Hall, Nairobi. What is the name of that church? How comes I'm forgetting? Is it the Holy Family Basilica? No. Holy Family Basilica is quite far. Yeah, cathedral, yes. So cathedral, ladies and gentlemen, have you ever seen any church that resembles this church in terms of buildings in Africa? Or just, is there anybody who has seen any church, who has ever seen any church that has got buildings like the ones in this case that cathedral has? Maybe most of us do not know what how cathedral looks like. How about Don Bosco Catholic Church, Don Bosco at Upper Hill? All right. I mean, that is a very unique organization. So if you're given that kind of organization to value, there is nothing that is identical to it. There is nothing that is even similar to it. I mean, this one is what we use the concept of an observable inputs to value them. And I'll be able to really sit down with you here, of course, virtually, and demonstrate to you how do we do those kind of valuations? How do we do those kind of valuations? Ladies and gentlemen, from there, under topic number 1, we have 1.8, what we call impairment of assets. Impairment of assets. Ladies and gentlemen, when you talk of impairment of assets, basically we're looking at an asset that is losing value. An asset that you have held in your books of accounts at some carrying amount. The carrying amount is, for example, 20 million in your books of accounts. And then later on, you come and realize that when I try to look at this asset, I mean, what I'm able to recover from this asset, the recoverable amount is 15 million. 15 million. You see, in this case here, the carrying amount, recoverable amount in practice here, there's a mismatch there. This carrying amount that I'm holding, this asset of mine in my books, is fake because I'm only able to recover this much. So it means that the asset has been impaired. We are going to see, ladies and gentlemen, whenever we talk of impairment loss, we shall be talking of CA minus RA, where CA is the carrying amount. In this case here, RA is the recoverable amount. By the way, there is something I never said here as I began. We have not yet started teaching. Don't think that Mwalimu is moving very, very fast. I'm trying to give you a broad overview, actually, of the entire subject. And then in my subsequent session, I should be able to begin teaching you guys. Are we in agreement with that approach? It's good you get a broad overview of the entire subject. Are we in agreement with that approach? Do you think that approach is good? Do you think that approach is good? All right, yes. All right, yes. It's very good for you to be able to. So impairment of assets, we are looking at what we call the loss in value of assets. And it's not assets alone that get to lose value beyond depreciation. Even as human beings, there is what we call impairment of assets. Impairment of human beings. All right. What do you mean, Mwalimu? You can imagine here you are, you've brought in a great lady, you've done some great wedding here, and you paid a dowry of 3 million. I don't know whether this is a very good example. You've paid dowry of 3 million. And then this young daughter of somebody here comes in this case here to the house. You've married her. She can't differentiate between uji and ugali. You ask her to make ugali, she brings you uji. Honestly speaking, what value are you getting from this lady? What value are you getting from this lady? All right. So in this case here, if you paid up there and what you were able to value, able to get from this lady is down here, then we talk of what here? Impairment. But if the value she's giving is up here, all right, then we don't talk of impairment there. Whenever recoverable amount is higher than the carrying amount, there is no impairment. Impairment only happens when the carrying amount, what I'm carrying amount is also known as net book value. When the carrying amount is up there, and then of course recoverable amount is here. The same case with the gentleman. Will you get a gentleman who will come and cheat you like the whole world? And then when you get in, you realize that the recoverable amount of this guy is negative. This is a guy who is even eating your money. All right. So in this case here, this is an impaired asset. But unfortunately, the holy books will tell us to live with these people forever. There is no way of getting out. We must, in this case here, build each other until now we reach that level where we are able to get higher recoverable amounts. Ladies and gentlemen, from there, we shall go straight away to preparation of financial statements for interest in other entities. If you have interest in other entities, you have subsidiaries, including foreign subsidiaries, very common. We have piecemeal acquisition, reduction in shareholding and disposals, as well as statement of cash flows. We have our accounting for associates and joint ventures. That is IAS 28, including foreign entities. Disclosures of interest in other entities, very, very important for us to know how to do these disclosures through what we call related parties. Then we have 3, preparation of financial statements for other entities. For other entities, we are mandated to teach you how to prepare financial statements here for banks. We need to know, for example, the revenue sources of banks. They are getting interest, they are getting commissions. So much 3.2, we are also required by CASNEB to teach you guys how to prepare financial statements of insurance companies. Then we must know how to do interim financial statements. And then we have financial statements in a hyperinflationary economy. You'll allow me to use bad examples, bad examples today. I'm going to use hyperinflationary economy. The word inflation, of course, is well known to everybody. All right. But now the concept of hyper. You'll be asked characteristics of hyperinflationary economies. Like Zimbabwe some time back here. Even right now, it's still a hyperinflationary economy. The citizens do not believe in their currency when we have hyperinflation. With the hyperinflation, the citizens would want to keep their wealth in terms of other currencies. Like even in Kenya, we were hitting this hyperinflation thing. There is a time, like I was buying some apartment, and this person was saying, no, you can't pay me in form of Kenya shillings. You must pay me in form of, when I looked around, this guy is a Kikuyu. Why does he want me, in this case here, to pay him in dollars, and yet he's a local guy here? And then I remembered very fast hyperinflation. When there is hyperinflation, people do not believe in their currencies. They start, in this case here, asking to be paid in form of like US dollars. Even locally here, now there are very many establishments that have really pulled the card over only accepting US dollars. Like Panari Hotel. If you go to Panari Hotel today, eat anything there, they can't allow you to pay in Kenya shillings. And it's not only Panari. So many other hotels and other establishments currently they will ask for the dollars. That's a very good qualification, a very good, ladies and gentlemen, in this case here, characteristics of a hyperinflationary economy. Then in a hyperinflationary economy, there will be sudden price changes. You're just eating food in a hotel. Then in this case here, a waiter comes and tells you, this thing is worth 200. And then later on, this waiter will come and tell you, this thing is worth 250. All right. So in a hyperinflationary economies, for those of you who have been in countries like Zimbabwe, I mean, you can't even eat in a hotel very comfortably. You will get people going, buying their food, and they're eating even outside there because you should pay up front because you don't know what will happen here. So things change. When it's inflation, it's quite normal. The price change, like now what we see with our petrol industry, we are having like one-off per month price changes. But if that product was to have like quite high fluctuations in terms of price like every hour, then that becomes a hyperinflationary. The other thing you're supposed to know, ladies and gentlemen, if it's a hyperinflationary economy, people will prefer storing their money into other assets. So they get money like today they have stolen, they keep on buying land. Like there is a time in Kenya, everybody was about Mogonda, Maguta, if you remember. That's a very good characteristic of a hyperinflationary economy. But fortunately, Kenya, we have never hit there. As you're going to see, ladies and gentlemen, hyperinflationary economy is that economy where the inflation, the price changes will go more than 100%. More than 100%. Land was 1 million this year. Next year, it goes to 3 million. That's about, it's quite a high increase. All right. So we're going to look at this. Very interesting stuff, ladies and gentlemen, and everybody will be very happy. Everybody will be very happy because this is a subject that is supposed to expose you to the real world of accounting. Now, from there, ladies and gentlemen, if you allow me, I'll be able to go straight away to financial statements complying with IFRS for SMEs. Remember, we've got two types of IFRS. We have a full IFRS and we have a IFRS for SMEs. Full IFRS is the one that is used by listed companies to produce their financial reports. And then we have IFRS for SMEs. Like now, RCM is an SME. If you tell us to adopt full IFRS, it means we must hire like 20 accountants. We don't have that capacity. So then we have, in this case here, like a mini IFRS, which in this case here tells us that you guys, you don't have to do segment reports. You don't even have to produce interim reports. You don't have, I mean, there are so many exceptions to simplify things for us in the SME level because they appreciate that we don't have enough resources. We don't have enough resources. All right. So you'll be able to see like this question keeps on coming every item, that give us the exceptions, give us, in this case here, the standards which are left out whenever we talk over IFRS for SMEs. One of them is IAS 33, earnings per share. We don't do earnings per share for SMEs like that. Very interesting stuff. All right, ladies and gentlemen, from there, we have, in this case here, analyzing financial statements where they want us to look at earnings per share, related party transactions. Remember, theft normally starts from home. Theft normally starts from home. I'm aware that there are wives who steal from their husbands and there are husbands who steals from their wives. Is there any lady here whose husband has ever stolen anything of theirs? Of course, we don't steal. We only put them in a good place and we refund later. But is there, ladies and gentlemen, even within companies, normally theft starts from home. Theft starts from home. And that is why you are required here to do disclosures regarding related parties. Like, for example, if it's RCM College, the financial reporting framework is very, very clear. It tells me disclose your key management staff and their families. So I'll come and say, this is the CEO, this is the family, these are the children, like that. Why is that important? Because you see, if it's RCM and Joshua who happens to be the chairman of the board or the principal of the school, there is a way, even if my wife doesn't have any shares, there is a way she'll be able to come and interfere. It's normal. So you don't have to have the key management staff having even shares. You know, by you having shares in that company, it's indirectly they own the company. Indirectly they own the company. So they can come and they interfere and override controls. And at the end of the day, why are they overriding controls? To steal. They bring in their suppliers, etc. And the related party transactions, will be able to see the disclosures. You must tell us who your parent is. If you're a subsidiary, who is your parent? Are there any exchanges you're having? Do we have any internal transfer of assets? Because in most cases, remember, these related party transactions bring any company to its knees. Look at, for example, the CMC saga. CMC, they went ahead and opened branches in Southern Sudan. And then now the Southern Sudanese branches were the ones bringing vehicles from abroad. And then after they bring these vehicles from abroad, now they were selling these vehicles to the Kenyan parent company at exorbitant high prices. Who are pocketing the profits? I don't know. The case, I'm told, is still in the courts, but I'm told that the people who are pocketing the profits were not even, it were the directors. So normally IFRS framework is very, very clear. They will come and tell us if you have got any related parties, relatives in the name of persons, in the name of, for example, body corporates, you need to disclose them. And I'm going to teach you very well how this standard works. All right, ladies and gentlemen, from there, they want us to come under IFRS 8, show you guys how to do segmental reporting. Then we have 4.4, financial reorganizations and reconstructions, a very, very important topic that never came last semester. So this semester, they have to bring it. This one, mark my word. for those of you who will become CEOs, CFOs, it's not going to be that rosy throughout. Life, of course, just like it is in life, body corporates also keep on hitting bumps. Up, jumps up, comes down tumbling, and then the journey continues. There is a time you'll get yourself at the brink of bankruptcy. Then at that stage, you will have to ask yourself, do I let this thing go? Or in this case, do we bring in experts like receiver managers and liquidators to we sit down instead of liquidating this thing? How do we reconstruct this company? Can we negotiate, for example, with debt holders? Tell these debt holders, if you guys let us go to the drain, then you're going to lose so much. You would rather just help us, we get on course, and then we shall be repaying you these debts like this, because there is no company that goes under and then creditors at the end of the day are happy. No. I mean, what will you be able to recover from this? So negotiations, we're going to see ourselves here creating schemes for companies to come back alive. Very, very important. To come back alive, very, very important. Reconstructions. And you're going to see very good things here. There are situations where even if you try to squeeze water, nothing will come out. It will be as good as squeezing water from a rock. Nothing will come out. So if that is the case, then now we'll be forced here to transfer all the assets to a new company, to a different company. So we shall be getting help from outside. We call that kind of an arrangement external reconstruction. We have two types of reconstructions. We have internal, where we sort our mess, see, for example, how do we talk to our creditors, etc., and then we get out of this mess with the time. We are taking care of our affairs. And then we have the external reconstructions, where now we break up everything, surrender those assets and liabilities to a new party outside there. We shall be able to learn these, colleagues, great things. Now, ladies and gentlemen, after that, we have here public sector accounting standards. Remember, the profit-making companies use what we call IFRSs, International Financial Reporting Standards, IFRSs, to prepare financial reports. And then we have companies which are in the public sector. Public sector companies are those companies that are not for profit. They are doing other great things outside there, but profit has never been their major objective, like Kenyatta National Hospital, like the UN. They've got other bigger mandates, other bigger callings, other than profits, like Catholic Church is doing great things outside here, I can tell you. It has a big, big footprint in the education sector. Catholic Church, all over hospitals, like they're controlling, doing great stuff. So they're not really after, of course, profit, they can't be making losses, but really their main objective is not profit. So such organizations that are not in this world to pursue profitability, they report using what we call IPSAS, International Public Sector Accounting Standards. International Public Sector Accounting Standards, like the ministry, government ministries, etc., they use IPSAS for their reporting. They use IPSAS for their reporting. So under IPSAS, your examiner wants you to appreciate this. Your examiner wants us to talk, it's the same things, wants us to talk about segment reporting, related party disclosures, impairment of cash generating assets and non-cash generating assets, disclosure of information about generating general government sector. Also, the government, remember, has got subsidiaries. So consolidated financial statements, investments in associates and joint ventures. And then we go to the last topic, great topic, ladies and gentlemen, other reports and emerging issues in the financial reporting. Where number one, this keeps on coming every other time, and my students are not able to answer because my students do not know things that they should take really seriously. But of course, I know the students who come through me, they really get so much through us, of course. We are teaching AFR, like how many teachers now here? 3 teachers. We have CPA Wabomba. I mean, he takes the evening class. We have, in this case here, myself here. I take the early morning class for those ninjas who love waking up at 5 a.m., 5 a.m., 5 a.m. And then, of course, we have other teachers there like Kyoko, although he doesn't come here, but they teach the physical classes. But occasionally when I'm busy, you can always see their faces. When you come through us, ladies and gentlemen, there are things you have to know, like the conceptual framework. Conceptual framework is different from IFRSs. Conceptual framework is like what the Bible is for Christians, for the pastors. Before a pastor goes to minister, this guy has to prepare. He has to write something here. So he's using this conceptual framework. In his case, is his Bible. So the same case with International Accounting Standards Board. Whenever they are making a new standard, they have to look at the concept. They have to look at the conceptual framework to be able to generate standards. You accountants, of course, I know you have not been using this. If there is something you're not understanding very well, whenever you want to make reference and get broad and deeper knowledge regarding a certain standard, you go to the conceptual framework. Conceptual framework. If you look at the past papers, I'll be able to show you conceptual framework, ladies and gentlemen, is all over. Now, ladies and gentlemen, you'll always be asked about, if you look at these, I mean, here you must get a question from here. The process of developing new accounting standards. You know, ISB body does not wake up in the morning and then they say, hey, let their IFRS 54. There is nothing like that. But they don't just come up and say, hey, let IFRS 54, in this case here, wake up and jump up. No, it goes through a process for you to come up with a new standard. For example, we must have an agenda. We must have people coming together saying, hey, the way this standard, the old standard is not really giving us what we would want to showcase. So there must be an agenda, either from ISB itself or even from outside. So this agenda, once it's taken to ISB must come up with what we call a task force. The task force will be able to evaluate this agenda. And the task force straight out will start now looking for information from everybody, from accountants here, from member bodies, which are, in this case here, closely associated with the ISB, like ISPAC. We have ACCA, so they send out what we call memoranda, that we have got this, what are your opinions? And then these guys are able to return back their opinions. Once they turn back their opinions, again, this task force will be able to sit down, evaluate whatever is there, and then now they come up with a summarized document that will be taken outside there now for serious discussions. The discussions and the exposure drafts. Exposure drafts, again, will be given to the same stakeholders. Now, this time around, they even publish them on their websites and ask for opinions like that. And then at the end of the day, ladies and gentlemen, people will be able to return again something better. So they keep on refining it to the point now they are able to say, hey, now we have a new standard. And of course, whenever there is a new standard, we must also always have what we call monitoring and evaluation, M&E. It's not like you have just developed a standard and then you leave it like a vehicle without a steering wheel. No. We must be there to monitor. We must be there to evaluate, see how companies are now reporting using it. In case there are any issues, we must tweak them. We must keep on tweaking them. So standards are never cast on stone. Standards, ladies and gentlemen, these are live documents that are always on the road, transitioning to new things. I'll be able to give you that format very well. I'm just putting this at a high level. Later on, I'll be able to really explain, in this case here, these things in detail. Then we have here proposals to revise, update existing standards that already have mentioned it, and recommendations to issue new ones, discussion papers, and exposure drafts. So the examination board, which is KNEC, shall provide guidelines on which discussion papers and exposure drafts are examinable for specific years. We have never seen this. No, we don't cheat. We have never seen this, but we shall overcome. But fortunately, we have past paper questions here, and given that Mwalimu is a member of ISPAC and a member of ACCA, I know where to get them. So you should not feel disadvantaged, really. 6.3, management commentary, management discussions and analysis. Ladies and gentlemen, it's good to be old. It's good to be old, and it's good to be young. It's good to have the two of us coexisting. Was it last year? Somebody came and told me, Mwalimu, it's just a student. Mwalimu, you can't just stay like that. But now, like since we started working from home, I rarely leave. I got a very good employer who allows me to work from home 100%. So this guy told me, come to, is it Quavers here around the Thika Road? So I went there. You know, ladies and gentlemen, things are changing very fast. The kind of music, you know, my music is very different. At almost 50 now, my music is very different. So when I was there and I told you this thing, their music, which I listened to there, of course, it was very boring because now I could not see people of my age there. But at least, unapata kuna kitu najifunza kwa hii vitu. Unapata kama ingine liimba wimbo ikaniambia, ati mimi ni tajiri, nimesahau hiyo wimbo kwa nini. Mimi ni tajiri kushinda babako, na hizi pesa ni za babako, wewe kasikie vibaya huku kwenu. Unajua ni mafunzo mengi sana. Hiyo ni mafunzo mengi sana. Mafunzo mengi sana. Ukiwa mzee lazima ufikirie sana. Hiyo wimbo nimenishinda kidogo, hiyo chorus imenishinda kidogo, lakini imenishinda kidogo. Imenishinda kidogo, but I shall overcome. I shall overcome. 45 to be very precise, but we shall overcome. Now, ladies and gentlemen, the point is this. During our old days, we used to have financial statements packaged as income statement, cash flow statement, and the balance sheet. And they were putting, actually, there was nothing like changes in equity. I mean, nothing like that. It was only cash flow. It was only income statement. It was only the balance sheet. They used to call it balance sheet. Those three, they were putting them together and furnishing them to banks, furnishing those statements, in this case here, to the Commission of Domestic Taxes, etc. But now things have changed. Like right now, if you produce those three statements and then you take them to a bank, people look at you like you're crazy. You are abnormal. Right now would want like an introduction. Thank you so much. You need, in this case, like an introduction. The managers must be able to tell us what this thing is about. They must discuss the macroeconomic environment using pastel, political, economic, how politics affected the company, the economic metrics here, etc., social metrics, pastel technology, etc. So all those discussions that are normally done by the chairman of the board, the CEO and the CFO, they fall under what we call MDAs, management discussions and analysis. You can't get financial statements without them. Very, very important. And of course, as an auditor, when I come to audit, I will not only look at those financial statements, I must also look at the MDAs to see where there is a place they are cheating. It's not my responsibility, but I'm required in this case here to read them to see how well they are aligned with the numbers. Are the numbers saying that gross profit is going down and directors there are cheating the public? That should never happen. So MDAs, management discussions, and analysis. Now, ladies and gentlemen, we have your management commentary. Management discussions are very, very important. From there, we have Capital Markets Authority corporate governance reporting requirements. Ladies and gentlemen, I travel quite a lot. And I can assure you, most of the companies in Africa, in the international markets, they are dwarfs and the dwarfs of dwarfs. In the international market, you can't hear them. Go to China, you'll hear about US farms, you'll hear about European country farms here, but rarely will you hear anything about an African farm. Very, very, very rare. Very rare. All right. Don't tell me that Safaricom is not outside there, because when Safaricom, do you own it? More than 50% of Safaricom belongs to outsiders there. The same case with the EABL here, Diageo is a foreign investor. All right. Why do you think, do we have our organizations not really living, in this case here, this cocoon of what here, dwarfism? It's because we don't believe in sustainability, we don't believe in corporate governance, we don't believe in internal controls. And worst of it all, corruption, yes. Worst of it all, when I read my Bible, there is somebody who was cast, and he was told that he was cast with his generation. Is there somebody who is good with Bible here to help us and tell us who was that? What is the name of that person who was cast together with his generation? There's a person who was cast together with his generation. That I'm casting you, that was a very bad cast. How would that man be cast like that? I'm casting you, your children, grandchildren, ancestors, son of Noah. I don't know. Son of Noah, who is that? And then here I don't have very good studies of the Bible. Here I don't have very good. It was not Cain either. It wasn't Cain either. When I look at that lineage, I tend to believe that that person must have been an African. Ladies and gentlemen, our affinity for stealing is so high. We hate working. If today you go outside here, like along Mombasa Road, etc., clubs at this time, they're full. All right. We would like to party so much, and in this case here, do very little. So at the end of the day, we like stealing. We like stealing. And this is what capital markets Ahab. I'll remember the name. I think Ahab is very close. If not Ahab, we should be able to Google. I think it's Ahab. God forgive me, but that Ahab must have been an African. Must have been an African. So we could be cast, and that is why we need to pray a lot. And we don't know. I know we are hardworking, but again, Ham, okay, Ham. It should be around there now. Yes, it is Ham, yes. It is Ham who was cast together with his generations, yes. It was Ham, yes. Yes. Now, listen and listen to me. We really need to do something. That is why CMA, Capital Markets Authority, now they have what we call corporate governance. And in financial reporting, we must be able to say, for example, under corporate, who are governing this company? Who are the directors? How many times they get to meet? All right. Are their decisions respected? Are they a progressive board, for example? Do we have the chairman who is quite, or rather who is different from the CEO of the company? Because the two positions should never be held by one individual. Because that individual, and again, he happens to be a black man, automatically, that company. You know, I was reading somewhere that in Kenya here, about 65%, 65 to 70% of employees go to their workplaces every morning with an intention of stealing. It's very, very sad. I would want students in this case, even walimus, or even my own friends, where I tell them, myself, I would love to be working like throughout. Like now today, I'm finishing this class. I have an advanced Excel class at 4 p.m. I am meeting these guys of AFM. I mean, all through. Of course, I create time also for other things, but I would rather work so hard so that one day RCM as a college will also be able to stand out and maybe be listed and stand out, especially in the international market, be able to get market share in terms of teaching ACCA students, etc. So we really have to love our work as per the CMA regulations, corporate governance. I'll be able to take you through for you to understand what all that means in terms of financial reporting. Ladies and gentlemen, remember, financial reporting is one of the key controls. Internal control systems are those umbrellas that you're supposed to be putting in place to ensure that you're not rained on. So even companies, we need strong financial reports which are accurate for us to be able to deter theft and fraud. So if you get these financial reports, ladies and gentlemen, that are really not able to cover, unapata mtu umetembea na kaumbrella kama mtoto mdogo namna hii, kana cover hapa peke yake. Hata sasa ni umbrella umetembea na hiyo, ndio Kiafrika, unakuliwa huku, unanyeshewa huku namna hiyo. CMA is looking at sustainability, then we will have to see whether these financial reports, are they complying with the CMA regulations, etc. All right, ladies and gentlemen, then if you allow me, I'll be able to go to straight away 6.5, where we're talking of global reporting initiatives, guidelines on sustainability reporting. Ladies and gentlemen, I'm so worried with these floods. Trust you me, and given what I normally read on climate finance, sustainability finance, we are doomed. Of course, we are trying to do our best under the United Nations development goals, where sustainability is one of them. But I don't know whether this is a journey walking in too late, because we should have started pushing farms long time ago. These farms are emitting, in this case here, pollutants to the air, which are causing global warming, which are now making us get some weather patterns that we have never experienced. As I've told you from the beginning of this, there are now people, even here, and I'm really sorry, there must be people here who are really, really affected by these floods. I mean, people who are doing like large-scale farming, whose tomatoes, as we speak, now are down there. Nothing really. All right? So then we have sustainability reporting. And as sustainability reporting, as a good accountant, you are required here to always report your activities as a firm using the 3 Ps model. You must, of course, tell us something about profit. Companies that are not able to make profits are not sustainable. Companies that are not able to make profits are not sustainable. That is the first P. The second P is about planet. I mean, if we don't take care of our Mother Nature, when Mother Nature shakes a little bit like this, and the sun comes down even by 3-4 inches, we die, all of us. Ozone layer, you know. So we must report as a company, as a RCM, what are we doing to save this environment for this business and our generations to be sustained as we move along. So for example, are we using the 3 Rs? Do we have this concept of reuse? If, for example, you have printed on a paper one side of this paper, do you just throw that paper, or do you have a policy of saying, let's in this case here have this thing here, next time when we print we shall be able to, because we must have this thing of reuse. Even water, we should not be having water like it's moving from just the kitchen sink and taking it to the drainage. No, we should be able to have like they have outside there in these developed countries like Sweden. We should be able to have situations where we clean water that we can manage to clean and then recycle this. There are situations that I expect to see you, especially men who are around here, where you are refusing packaging materials. I was telling you yesterday, you've gone to a supermarket to buy cabbages. What do you have to hide? Unless there are so many. It's yours, you simply carry. So when this lady is giving you like a carrier bag, you tell them, no, let me just carry like this. You go. You should be able to carry, in this case here, your old bags, to a supermarket and reuse them. If you want to really take care of this, it's only in Africa here again where we are not very serious on climate change. This climate is changing. It is changing, and the way it is changing in a very, very fast way. If you're not careful, ladies and gentlemen, we as accountants, we have a role to play. So whenever we are reporting, let's always come and tell the whole world that we were able to buy this carbon. Carbon will be bought. That's what we call carbon credits. Because in this case here, we have to pollute the air as we produce. Then we bought carbon credits from other farms, so that these are the farms that get cash from the carbon credits. They should be able to go and now become better even to the environment by planting more trees, etc. So you should be able to have like a carbon rating. In Kenya, it is not yet there, but we need to have it so that the heavily polluting organizations should be able to give government of Kenya lots of money because they are polluting the environment. All right. And then, of course, now the government should be able to go and make good. We should be able to plant trees crazily. Just like, for example, if you have got floods coming up from, for example, these dams. I mean, like anywhere around dams, we need forests. So that should we have spillovers, then we should be having this tree should be able to hold on to some of this water to move downhill with lots of speed. We should be having forests like we do in Congo. Congo is really green with those heavy African indigenous trees. In Kenya here, those were long cut because of what here you and I know, because we want to become rich very fast. That richness will be, in this case here, buried. Within a day, you will be having nothing. So under sustainability reporting, it is 3 Ps. You must report on profits. You must report on planet. You must also report on what we call people. People is a stakeholder management. So under people, you must tell us, are you very good to your employees? Are you paying your employees some good salaries, or you're giving them what we call ochugunu? Ochugunu is a German language meaning what here? Small. So your employees can't even afford bus fare. They have to walk from Mathare North to industrial area. No. How about the surrounding communities? Do you have CSR activities for them? 3 Ps. We have people, we have planet, we have profit. That's what we call sustainability reporting, as it has been given to us by the GRI framework. Ladies and gentlemen, from there, we have what we call integrated reporting. So integrated reporting, of course, we are looking at the first G. First G is you report just very similar to sustainability reporting, but you shall report on financials. You shall report on environment. You shall report on your social enterprises and activities. And then, of course, we have governance. Key. Governance is key. if you're a college which does not have very good governance structures, you're not going anywhere. If you're a college and you're dependent on one individual, when that individual dies, the college dies. So you must get, if, for example, you're Aura, and there is a time that RCM was really about you. No, you must know how, in this case, you have to make backward moves a little bit. You keep on releasing these papers. Of course, it is will complain here and there, but you know whether you like it or not. We shall always have younger men who will be able to do these things better than you. All right, you go and take a strategic role where you become like a bigger marketer, bigger umbrella, but at the end of the day, bring in. That's why at times I sympathize with even big companies, listed companies like, for example, Equity Bank. Can you imagine Equity Bank without James Mwangi? I don't think it will be there. Because James Mwangi has been able really to put it very close to his heart. And the guy is so talented. Anytime you hear him in China, he's talking about this. In Congo, he's opening branches. That guy, even does he sleep? He's very good. But again, remember, we have what we call one-man syndrome. One-man risk. In case he goes down, chances are, it may not go down 100%, but there'll be a very, very big dent. Sustainability wants us to report about governance, about those issues. Do you have what we call succession planning? Do you have gender balance? Do you have a progressive board? All right, we must disclose all that. Very, very important. All right, now, ladies and gentlemen, from there, we have here legal and materiality guidelines for financial reporting, and then we have legal and ethical issues in financial reporting. Very, very important. Very, very important. All right, so ladies and gentlemen, I'll be able to show you something very important here in terms of reading materials. I would expect all of us to procure this revision kit. I'll be able to give you all the other content, but I would want you to buy this revision kit. It goes for 1,000 bob from the beginning. If you would want to get it as my student, you need to call our numbers. You guys have our numbers: 0793 555 000. I'll be making reference to this kit often as we continue, so that every time we talk of a question, of course, you will be having the questions, but it's good to have like a revision kit which has got questions and what here answers. And I would want to make this lesson very, very practical. Very practical. Very practical. Just give me a minute. I show you why I'm talking about making this very practical. Like right now, as you guys wait for Mwalimu to get his financial statements, I would want you to go and Google. You Google there, financial statements. Yes, I will be sharing. Yes, Marianne, I must share. They're actually online. You'll be able to get them very fast. So I want to look for EABL. Annual report, 2022 annual report, It's a PDF report. Great, because we have to be very practical. These guys would want you to put your birthday for you to download document there. All right, great. Great, I'm downloading this document because I want us to be very, very practical. All right. Great. So, and I'll be making reference to these articles often. So I would want you to download both of them. I'll be making reference to EABL's integrated report. and Safaricom integrated report. Those two, if possible, please get them. And if possible, please print them. So like you can see here, EABL since 1922, celebrating life. I don't know the life, which life they're celebrating, but I like how they do their financial reports. They must be hiring, 2022 integrated report and financial statements. So now you see, once I show you this, you'll be able to remember what integrated reports are. You can see their taglines: 100 years old, 100 years bold, since 1922. You can see they're giving us their flagship project. And when I look at my audience, I'm so sure my audience does not even know what EABL sells. These are young people who go to church every day. You can see like their very first factory, it was quite a dirty one, but still there. They're giving us a chronology of their company, about the report. Like the framework they're using, our integrated report is prepared in accordance with the International Integrated Reporting Framework, adhering to fundamental concepts. The annual financial statements were prepared in accordance with the IFRS. The report is part of our commitment to being transparent and accountable to our stakeholders. The group constantly considers whether there are additional reporting frameworks or metrics we could use to enhance our disclosures. So assurance, of course, PwC is their auditors. So now we have the table of contents. So you can see EABL overview, our business model, stakeholder engagement. I told you something big about people, our performance. You can see they have a section for corporate governance. Who are the board of directors, senior management? They have a corporate governance statement. And then now we have financial statements coming from page number 116. All the others are preambles, but very, very important. Ladies and gentlemen, if you can see like now here, we have our performance. This basically are the management discussions and analysis. Group chairman statement, group managing director statement, group chief finance officer statement. All right. And I would want to jump here like a gazelle to page number 14. I would want to jump like a gazelle to page number 14. You must always, whenever you are preparing financial statements, you must always give us the business model. We don't want to hear companies that are making money from money laundering. So you must tell us, how do you make your money? We are proud to grain. We are a proud grain to glass business, with the consumer at the heart of our business. Our business operates with the simple purpose of supporting our consumers in celebrating life every day, everywhere. I should be able to take this statement to our RCM online classes. We help you celebrate life every day, everywhere. Where you guys are at, we're able to access So you can see research, what they're doing, their business model. We don't want those kind of businesses where we ask you like, how do you make money? And then you tell us it is God. You know, there are people who always tell you it is God. It is God. We know that God is gracious and really assists everybody. But the financial reporting framework under IR, one of the components, you must give us your business model. You must give us your business strategy. Don't fear. You give us all those things like that. Ni God. It's God who gives you powers, yes, to even do all this. To even do all this. Stakeholder engagement, who are the stakeholders? What are they doing to them? You can see they even have a statement on gender, equality, inclusion, and diversity. Very, very important. Performance highlights. Now it is immediately after this that we have the group chairman statement, the management discussions and analysis. I'm very pleased to share with you our report for fiscal year 2022, a period which saw regional economies begin to recover from the impact of the COVID-19 pandemic. As you know, our two previous financial years were deeply impacted by the vagaries of the pandemic. And our focus then was to protect our people and the business. Fiscal year 22 has been a much better year. Not only have we seen a full reopening of our economies in East Africa, but we have also witnessed a resumption of our own trade business. Despite the challenges, our focus and agility, like agile businesses, and agility have enabled us to navigate the volatility and deliver strong performance. So you can see management discussions and analysis. The senior managers must state something. Our employee engagement remains high, and we continue to invest for long-term growth in our brands. So the moment you go through these, and the one of Safaricom, those companies that normally win what we call FIRE awards, financial reporting excellence, that you can Google. Even Stanbic is very good. They've done a very good job in terms of financial reports, integrated reports, FIRE, Financial Reporting Excellence Awards. You get those statements, you read them, and then work so hard in your written English. I would want you guys to be at the forefront of writing these things for companies. Very many companies outsource this functionality of being written, the financial reports, of course, for them. Very, very important for us to be articulate in writing them, All right, that is it, ladies and gentlemen. Having been the first session, I think we have done justice in introducing the subject. For those of you who are pretty new to Mwalimu here, my name is Dr. Joshua Aura. I teach AFM, I teach AFR, I teach BDA, all right, at RCM College. If you're interested in joining us, please give us a call. 0793 555 000 is our number. 0793 555 000 is our number. Connect, learn, and grow with us. Thank you and bye. Bye. AAA, yes, we have AAA. We have AAA being taught by who? By CPA Kenyani. All CPA papers, we have them. Listening to you, great, Shiko Mwaneki. Ah, great. But Shiko Mwaneki, have you finished your CPA? Have you finished your CPA? It's good to have you around. I normally see your name. Very good. Very good. We shall overcome. Very good. So thank you so much, and bye-bye. All the best, and please, awaiting results, great. So please continue listening to these kind of talks, and perhaps if you have an interest to become a teacher, maybe that's why you're listening to this, let's have a discussion. Would love to have, for inclusivity, also ladies teaching these CPAs. All right. All right. Thank you. Thank you. Let's strive to make RCM College the #1 college in East Africa. Bye.